call in. So hello, if you are on the East Coast, good afternoon, and thank you so much for joining us for today's webinar titled How to Successfully Engage Private Capital Investors. My name is Marissa, and I am part of RTI's Valuation team working to support Catalyze. And today I have the privilege of introducing our speaker, Dr. Steve Flaim. Dr. Flaim is a technology and business advisor to the Institute for the Global Entrepreneur at the University of California, San Diego. He also holds two positions at the NIH, one as a senior special advisor and investor in residence with the Innovation Office of the National Heart, Lung, and Blood Institute, and the other as an entrepreneur in residence with the Small Business Education and Entrepreneurial Development Office. Dr. Flaim has worked closely with us on the Catalyze program, providing pitch coaching to our investigators and several webinars, which we continue to be so grateful for. And with that, the floor is all yours, Dr. Flaim.
Oh, thank you very much, Marissa. So I apologize, everybody, for being late. We had trouble getting onto Zoom here this morning, and so we're sort of kludging this together. But we'll do this as best we can. So I'm Patrick. You're going to run my slides, right?
I'm going to run them, Steve. It's Kim.
Okay, great. So I'm on the title slide, and basically what we're going to try to do here is talk about how to successfully engage with capital investors. And I'm specifically speaking to the audience, which is largely the Catalyze program. So we're talking here about technologies that are in universities, early stage technologies, maybe some early stage companies. So let's go to slide 2. The agenda that I have in mind for today is listed here. So we're going to talk a little bit about the capital ecosystem for beginners. And then we'll focus in on a little bit of information about angel investors, because I think this audience is most appropriate for the angel investor sector, but we'll talk about some of the other investor types as well. We'll move to what is a fundable company and how do angels look at companies and determine that they're fundable. The next thing is how to pitch to an angel group or an angel investor. Then we'll look at the process that angel groups use to determine who they want to invest in. Say a few words about the due diligence process, which is what the investors do in order to decide whether to invest in a company. I'm going to spend a few minutes also talking about company valuation. We'll get to that. It's pretty complicated. And then finally, at the end, if there's time, I will run through a brief pitch deck template, which I recommend for early stage investors to use. Going to slide 3 then is we're going to focus first on the capital ecosystem, and slide 4. So here we're talking about stages of companies. So there are early stage companies and there's later stage companies. And I think most of the audience here would fall into the early stage. And so of the early stage, there's a series of steps. And so basically technology starts with an idea. Somebody has an idea in their head and they begin to do work, and they get to a point where they're conducting proof of concept. So that's a next stage. That stage, with their proof of concept work, they might reduce their idea to a bench model, a drawing, a prototype, something that can be realized and conceived. The next stage is a seed stage. So this is a point where the company has a minimum viable product that can be released in order to establish a business model. It needs to be scalable, repeatable, and it can be recognized as potentially creating a profitable business. And then finally, the last stage of the early stage companies are startup or launch, and these are companies that are getting ready to commercially release their product. And then we have later stage companies, which we're not going to spend a lot of time talking about, but they're growth stage companies. They're putting out a product and they're making money. They become mature, and then eventually at some point in time, they might decline for various reasons. Slide 5, please. So why would you raise money? There are positives and negatives to this. The positives is that you don't have enough personal resources to fund the thing yourself. You might need some advice and counsel and some committed, experienced business people to help you. You might need to grow faster than you can afford to on your own dime, or you might need access to a network. So those are all the positives for raising money and engaging with investors, but you got to realize that there's negatives. The negatives are that as you raise more money, you're selling more of your company to investors, and so therefore you start to lose control of the company potentially. And if you raise a lot of money too early, you will lose complete control, and somebody else will control the company. As you raise money, you have to have an independent board of directors, and they're going to help you run the company, and sometimes they may run it differently than you want to run it. Investors need an exit, and so they're going to be looking for a way to get their money out, and they're going to put pressure on you to build the company, get some revenue, and get to the point where the investors can exit. Remember that when you take on investors, especially early stage investors, it's like getting married. You're stuck with these people, you're going to do business with them, and so you have to be very careful. Slide 6. I want to spend a couple of minutes talking about this slide. This summarizes the capital sources over a company's life cycle. And if you look at the vertical axis, you're looking at cash from revenues. So the bottom is low and the top is high. And across the bottom of the slide, you're looking at time. And the large black line that's in there is basically looking at cash spend and earn. And so you can see that there's a valley of death that starts early, and then the company gets to a point where they have first revenues, and then they begin to, that black line begins to raise, and then eventually at the right side, if everybody's successful, they're making money. The slide is divided into different stages. So there's the idea stage, the innovation stage, the prototype, the introduction stage, the growth stage, and the maturity stage. And so in the idea stage, this is where you're doing proof of concept work. You can see that it's generally self-funded. Usually, sometimes innovators fund it by taking a mortgage out on their house, or they might have some other source of income. In order to get to the pre-seed stage, a lot of innovators go to accelerators. They might use crowdfunding source. They frequently go to government funding like NIH or SBIR, and there's friends and family, and these are individuals writing checks and giving it to the company. And this could be small amounts of money, all up to roughly $1 million. And that's kind of generally the case there. The startup stage is when you do a seed round, and a seed round can be anywhere from $10,000 to $2 million. And this tends to be an angel type deal, as you can see. The next stage is we call early stage, and this is where you move into a Series A, and a Series A can be 2 million to 15 million. And in general, I mean, some angels can get into that stage, but mostly this is a venture capital stage. And then later stages, companies do Series B investments. Series Bs tend to be 25 million to 35 million. Again, venture capital. And then later on, as you move into maturity, there can be Series C, Series D, whatever the company needs in order to eventually get to an initial public offering or an IPO. And a lot of times, companies go to banks for funding at that stage as well. So you can see that it's quite an ecosystem. There's a lot of moving components here. I have to say that a lot of these are pretty flexible. It's not necessarily always this well-defined, but it gives you some idea of what the ecosystem looks like. Let's go to slide 7. So what are the key capital sources? On the left side, you can see going down the source of the capital, so founders, friends, and families. We frequently say friends, families, and fools. This is the FF and F round. Angels, or sometimes crowdsourcing, venture capital, public stock markets, bond markets, and then banks. And as you go down that source of capital list, you can see where why these groups invest. The founders are committed, the friends and family are the believers. Angels want to help, but they also want returns. Venture firms, they just want returns. And then the public stock markets are trying to get a better return that would beat inflation. And in the bond markets, they're just looking for a stable return, and the banks look for a stable return with super low risk. The company stages are listed there. We've already kind of talked about those. But the one point I want to make here is that the risk goes from top to bottom. So the risk to the founder is infinite. It's super high. And as you go down that list, the risk becomes less. And so you get down to where the banks are involved. They're taking very little risk. They're looking for a stable return, but there's not much risk. And then finally, on the right side, the return to the investor, or the internal rate of return is listed there, is infinite for the person that takes the most risk. And as you go down the risk scale, the return gets less. So angels, for example, they're taking on very high risk, and I'll explain that later, but they need about a 50% return on investment. And banks, they're only looking for 4%. Okay, so let's go to slide 8. And I just want to reemphasize the capital amounts invested. So friends and family are going to invest upwards of $200,000. Angels and angel groups tend to invest between $50,000 and $2 million in general. Venture capital, $1 million or more. Crowdfunding can get up to $50 million, but there are many problems with that. And then bank can invest any amount, but mostly it's a debt or a loan. Slide 9. So just to distinguish between angels and venture capital. So angels are high net worth individuals who invest their own capital and experience with the intent to create value and to help the local economy. Venture capital, they're investment funds. They're managed professionally with the intent to create value greater than available through traditional investments. So there's a very distinct difference between angel investors and venture capital investors. Now I'm going to go to slide 10, comparing the capital amounts. And this is data from 2016, so it's a little old, but I think relatively speaking, it hasn't changed. So in 2016, there were 898 venture capital firms in the United States. They invested $77.5 billion, that's a B, into their investments. They did it in 7,750 deals, and the average round was $10 million. In the same year, the angel capital involved 297,880 individual investors. In aggregate, they invested almost $22 billion in their investments, and that was spread out across 64,360 deals. And the average investment round for the angels in 2016 was 337,000. So you can see that if you're looking for $500,000, you're in the angel world. If you're looking for $10 million, you're in the venture world. Okay, slide 11. So who are angels? Let's go to slide 12. So the angel, again, is a high net worth individual. They invest their time and money, and they're engaged with early stage companies. They are accredited investors. And so I always get questions of what's an accredited investor? So the Securities and Exchange Commission has a rule, and it's been in place for quite a while and it hasn't changed, and that define an accredited investor as someone with a net worth, the investor and the spouse together, of at least $1 million, and that excludes the value of their primary residence, or they have an income of at least $200,000 per year for the last 2 years, or $300,000 if they're combined incomes, two people married or whatever, and they have the expectation to make that same amount again this coming year and the years to come. So that's the definition of an accredited investor. So slide 13. So angels are wealthy individuals. They're usually working part-time, and they're doing this on the side as something that they're interested in, and it's fun. They often invest as members of angel groups. They invest their time and money in these portfolio companies. The typical individual investment is around $25,000 in a round of about a total of $750,000. And they invest in seed and startup stage, and sometimes in later stage companies. And they also understand that there is a need for follow-on investment subsequent to their round. So they're okay with that. They just need to understand the magnitude of that. And they have a strong interest in exit strategy. They need to get they strive to get their investment capital back with a multiple, and that is an exit. So basically, an exit is the company is bought out or it goes public or whatever, and the investor gets their original investment back with a multiple, and they strive for a multiple of 10 times. So that's generally the case for angel investors. Slide 14, how do you find angel investors? So I always recommend to people to go to there's an organization called the Angel Capital Association. Their website is showing there. And if you go on their home page, on that page somewhere, you'll find a button for members or find angels or something like that. And if you push that button, go to slide 15, you'll go to a place where it lists angel groups by regions. And so, for example, I've shown here the Mid-Atlantic region is circled in red. And if you push that button for Mid-Atlantic region, it will bring up this list below that's in the red square, and it lists all of the angel groups that are members of the Angel Capital Association that belong to the Mid-Atlantic region. So Virginia Beach, Baltimore, McLean, Virginia, etc. And if you push on one of those angel group links, it'll take you to their website, and you can see what kind of investment, because they always list their portfolio, you can see what kind of investments they do. Some angel groups don't invest in life science companies, and some do. And so if you're a life science company or plan to be, you need to go to angel groups that invest in life science companies. So that's how you find angel groups. And I just would say that angel groups tend to like to invest in their local area for the most part, although with the pandemic and with everybody going on the internet, that sort of rule is breaking down some, but that's neither here nor there at the moment. Let's go to slide 16. How do you find venture firms? Well, there is an organization called the National Venture Capital Association, nvca.org. You can go to that website, and they also have a find members. You can go to About NVCA, and if you go to slide 17, it shows up the list of members of the NVCA. And again, they give the links to their websites, and you can see which ones invest in life science and so forth. So that's the best way to find angel investor groups and venture capital investor groups. Let's go to slide 18. Now I want to move quickly to talk about the types of angel investing. And by the way, I'm not going to say much more about venture because it's pretty far down the line, and I don't think appropriate so much for this audience. So the types of angel investing. So angels invest in different ways. Most of them invest as part of a group or an alliance. These are individuals that work together. They invest individually, but they work together on due diligence and form term sheets and so forth. Then you have high net worth individuals that we call lone wolves. They basically invest on their own, and that's fine as well. You have to be careful. You want a lone wolf to be sophisticated and really understand what's going on. You don't. Sometimes high net worth individuals that are lone wolf investors really have an unrealistic view of angel investing. I think it's better to work as a group, but that's neither here nor there. They also work together on platforms. So these would be like online portals that curate deals and gather investors. So it's a little bit of an organized, it's not an alliance, it's a platform. And then finally, there are funds that pool capital into one or more deals from the members. So these are generally member managed funds. They are usually professionally managed. Sometimes they're called sidecar funds. They invest along individual investors within an alliance. And sometimes they use what's called a special purpose vehicle, which is basically it's an LLC type group organization that is formed to invest in a single company. So those are all the sort of the ways that angels do their investing. Slide 19. Why do angels do this? Well, there's three reasons. One is they feel like they want to have an impact. They understand that there is an economic impact to angel investing with jobs creation, economic diversity, inclusion, impact, etc. They also find it's fun and interesting. And I can tell you personally that I get to see things that the public won't see until 5 years from now. So you really get a chance to see things that are coming in the future. And then finally, angels want to have a return as well. You know, they're looking for a return and they're interested in that as well as working with the companies. Slide 20. I thought it would be worthwhile to just say, why do people become angel investors? Again, they want to participate in a growing economy, especially if it's in their region. It's known that small companies create the majority of U.S. jobs, and so angels feel like they're really having a benefit to their local geographic region. And then we also know that successful entrepreneurs create significant net worth for themselves and their investors, and so we want to participate in that as well. So slide 21 shows you a little bit of data. It's a little old. It runs from 1988, I think, at the bottom, all the way across to 2012. The vertical axis is numbers of jobs created in the economy, in the U.S. economy. And there's three different lines here. The blue line on top is the companies that are 0 to 5 years of age. The red line is companies that are 6 to 10 years of age, and the yellow triangles are companies that are 11 plus years of age. And you can clearly see that there are many more jobs created by early stage firms than by firms that are 6 or more years old. So this is really solid data that confirms the benefit of angel investing and getting involved in early stage companies for the benefit of the economy. Slide 22. Let's talk a little bit about returns. People say, why do angels need so much return? So, excuse me, angel investments are high risk and they deserve high returns. They need to have about 20% return on their investment per year. And if you think about this over a 5-year period, that's about a 2.5x multiple on your investment. And I can tell you that in general, angel groups, not necessarily individuals, but angel groups achieve this goal. But the problem is, and you've got to understand this, that 50% of angel-funded startups fail to return any capital at all. 9 out of 10 fail to return the capital that was invested in the 10. And all of the upside to the investor comes from one investment out of that 10 where they did get a return. So to achieve a 2.5x multiple for within a portfolio, there has to be 1 in 10 that gives a 25x return. And that basically assumes that everything else fails, which is a little bit pessimistic. A lot of times you don't get a 25x return, you get smaller returns, but you still have to get a significant return on a couple of your investments in the portfolio. So angel funded companies must have the potential to scale. So that's extremely important. Otherwise, you really can't get these levels of return. Go to slide 23. So of the companies that do provide a return, 70% return less than what was invested, 19% return between 1 and 5 times what was invested, 6% return 5 to 10, and 5% return more than 10x. So the angels need to figure out how to invest in what we call home runs. And so I can tell you that they go through all the diligence and they get convinced that this is a scalable deal and that it's going to be significant and they're going to get 10x return in 5 years. That's the kind of thing that you have to convince an angel group or an angel is true. Otherwise, they're not going to invest in your deal. Slide 24. So returns can be good. Half of all investments fail. you have to develop a portfolio approach, and each investment must demonstrate this opportunity to scale. And the other thing that's important to note here is that there's no relationship between risk and scalability. For example, restaurants with a potential for scalability and a 3x return fail about as frequently as a software startup with a potential for a 30x return. So that's a fact that everybody has to deal with. All right, slide 25. So angel investing strategy: 10% of deals provide more than 80% of the returns. Angels have to be diversified in their investment. They have to understand that all deals are high risk. We know that due diligence is important, but really due diligence only eliminates the stupid risks. And angels must invest for home runs, and they must invest for exits. All right, slide 26. Now I'm going to turn to angel perspective on fundability of investments. Slide 27. So first thing I want to say is that angels, and VCs too, will not sign non-disclosure agreements. The reason for this is that we're involved in too many different deals. If we started signing NDAs on all of our deals, we would never be able to go anywhere and do anything. So it's important that there is integrity in the investing sector. Otherwise, these groups cannot do business. We are not motivated to steal technology. That's not why we do what we do. There are cases where a company has potentially a very key piece of intellectual property that they want to protect, and they can, in some cases, during due diligence, maybe get one member of the group to sign an NDA and then report back to the group, yeah, this is real, these people really know what they're doing, we should invest. Usually it covers a very narrow set of issues. And so that's a possibility. It doesn't happen a lot, but it does happen. When you do a business plan or a pitch deck, don't include proprietary information. Or if you do, understand that you're trusting the people, your audience, that they will keep this confidential. Next slide, 28. So what do angels look for? They look for a unique product or service that solves a problem that is worth solving, and that we're talking here about over $100 million a year market eventually. And this can be reached through some kind of distribution strategy by an experienced team that can execute, and the process is capital efficient, and there is a real exit potential. Slide 29. So what do angels look for? They look for a complete, skilled, and experienced team. The company has an important problem. They have a working solution. They have a good value proposition, customer traction, sustainable and competitive advantage, a solid go-to-market strategy, adequate raise based on a solid financial plan, and finally, a clear exit strategy. Slide. For angels, this is the typical rating system. We're looking down the left at features of a company, management team, size of opportunity, et cetera. And across the right side is the importance of that feature. So management team is ranked at 30%. It's one of the most important features of a company. And as you can see, the importance of these features go down as you get as you go down the list. So management team and size of the opportunity are the big ones, and the other ones are important, but they're less important. Next slide. So let's talk about management teams. So first off, who's the CEO? Is the CEO coachable? And that's an extremely important feature. If the CEO is not coachable, angels won't invest in that company. The CEO has to have integrity. Ideally, they have some C-level experience already, and they have leadership experience. It's beneficial if the CEO has experience in the verticals associated with the company, and the team is already identified that the CEO wants to use. And then as far as the team is concerned, it needs to be balanced and complete, and it has to have experience working together. So those are all really important points on the management team. Next slide. Size of the opportunity. As I said earlier, it needs to be scalable. We're looking for generally $20 million at least in revenues in year 5. And I can tell you, venture firms look for $100 million or more per year in year 5. So they're further along type companies. It is a large niche market, is a good market to be in. It achieves high revenues with minimum competition. High gross margins are really important as well, because this allows the company to grow with internally generated cash, and that requires then less capital investment. And that's good for investors because they don't get diluted as more fundraising goes on. Next slide. In terms of product and technology, it must be available for customer validation. So we're looking for a prototype maybe, or a beta test stage product. Ideally, the technology is unique. There's some kind of patent or trademark protection, trade secrets, potentially some kind of IP protection strategy is in process. It has to be manufacturable in quantity, and that manufacturing plan has to be validated. Next slide. The intellectual property, again, patents, trademarks, trade secrets, there must be some kind of a competitive advantage. You don't want your competition that has a lot of resources to come in, reverse engineer your product, and then successfully compete with you. But the problem is that IP doesn't really bring a lot of values to startups early on, simply because the startups don't have enough resources to pay for the legal fees that they would need to defend themselves against impingement. So intellectual property really is more valuable to an acquiring company. They insist on intellectual property be in place, and a great IP adds substantial value at the stage of the exit of the company. So that you just have to keep that in. Next slide. In terms of marketing and sales, there should be some kind of customer validation in place. Marketing, branding issues should be addressed. Reasonable sales channels defined, some kind of partnership established ideally, and there needs to be some kind of competitive advantage identified. And these can be small competitors and even in a fractured marketplace. Next slide. So other issues, I mean, in terms of capital, you have to be sure that the round that you're raising is appropriate for the group that you're talking to. If you have to also be able to explain what subsequent funding is going to be required. And, you know, there's some other issues about international fundraising. These are okay. They do add complexity. It's better if you don't have to do that, but it's okay. It just adds some more risk. Next slide. So in summary, angels fund companies with market validation. They provide somewhere between 150,000 upwards to $1 million or more in some cases of startup capital. They look for startups with a highly qualified team, a venture with a large opportunity, a product technology with an unfair competitive advantage, and angels will anticipate a return of 20% per year, assuming that they only invest in scalable ventures, and they have to invest in a significant number of companies to get this. Next slide. I want to just say a moment about life science deals, because these are unique. Most startups do not ever plan to sell a product if they're a life science company. Usually they are linking up with major pharma or other major firms, and those firms tend to fill their pipeline with technologies coming out of startups. You have to pay special attention to the needs of the patient, which is not something that other types of technologies have to do. There's also a huge public interest in medical breakthroughs, and so that's a good thing, but it can also put a lot of pressure on the company. There's fear that product could cause serious harm, and so you have regulatory risk involved in getting products approved. Science takes a lot of time to validate in the form of a product, and the cost of research is very high, and it requires qualified entities to run the research tests, and like contract research organizations, and these folks are costly. It's likely to require 3 to 5 rounds of capital investment before a company is actually in serious revenue. And most startups and most investors just hope that these life science companies are successful, but they get acquired before too much money is invested. Next slide. I just want to point out that the cost of drug development is massive. So this was a report in 2014. They said that the average cost for one therapeutic agent was $2.25 billion. And this includes the opportunity cost for that money. The out-of-pocket cost is $1.3 billion. They have to spread this cost across all R&D and the cost of all approved drugs and also failures. So that's why the cost of drug development is so high. So angels tend not to get too much involved in drug discovery and development, but there are some situations where those are fairly good investments. All right, next slide, we're going to move to how to pitch to angel investors. Slide 41. Raising capital is a long and frustrating experience. You have to understand that angels process and how to follow it. So you need to set initially a reasonable value to your company, and you have to realize that everyone down the food chain must have the possibility of making money. I would advise you to approach investors as late as you can. So that means get your technology as developed as you possibly can before you start selling stock in your company. When you do go to an angel group to present, or VC for that matter, you have to prepare very carefully and then practice your pitch many times. It's good to get a mentor, somebody that can advise you on how to do this. We always say never build a model on 1% of China. That's like not a very good way to set up a market. Never say you don't want to give up control in your company. You are taking on partners, not silent investors. They want to know that you're willing to hand off control of the company when it gets to the stage where you're no longer qualified to lead it. So be willing to hand off the lead role in your company soon or maybe later. Next slide. The angel group deal flow process, let's go to slide 43, is summarized here. So it starts on the upper left box. Basically, an individual or a company is referred, maybe an online application. It goes to the angel group. It goes through what they call a pre-screening process, where the group looks at the technology and decides whether or not the group as a whole would be interested in it. Then if so, then you're invited to come in and pitch to the angel group. And generally, there's a lot of members sitting in the audience. And then after you've pitched to that group, the members that are interested in the technology will aggregate together and follow up. And a lead investor will step forward and say, hey, I really like this company. I want to lead this investment, and let's move forward. And then they form a due diligence group, and they look at all aspects of the company. Usually there's 4, 5, 6 people involved in due diligence. And eventually you get to, as quickly as possible, to a term sheet where you as a company and the investors agree on the terms of the deal, and then that's reported back to the angel group, and then we do what we call herding the investors. So now you have to get all of those people in the group who said they were interested. Okay, now it's time to write your checks and send them in. And in some cases, if the group can't raise the total amount of money that you're looking for, but they really like the deal, they will go to other groups at other locations in the country and do what is called syndication, and invite the other groups to come in and look at the due diligence and invest alongside if they so please to do so. And finally, the deal is, when the money is raised, the deal is closed, and the company gets the money. And generally, I would say that this actually happens in about 1 to 5% of deals that angel groups look at. Let's go to the next slide. So this is the deal flow pipeline. You can get a sense of how competitive it is. It starts out at the top with about 1,700 deals that come in over the transom or through the application process. About 400 or so go through meetings with the management. 60 some get into due diligence. Term sheets are agreed to and signed in 15, and investments eventually occur and finalized in 5. So you can see that that's a pretty tight funnel. Next slide is, we're going to now talk about the due diligence process quickly. Why due diligence? So this slide shows a little bit of data about the percentage of exits on the vertical and the size of the exit multiples on the horizontal. And the point of this slide is to show that the companies that where there's a lot of due diligence have a much higher rate of return than when there's low due diligence. And so the high due diligence companies are in the black, and the low due diligence companies are in the tan. You can see that the returns, most of the greater than 30x returns come from companies where a lot of due diligence was done. And the angel groups put a lot of time into these due diligence processes. The median time is 20 hours. 20-some% or more are over 40 hours of work, and it's all volunteer. All right, let's go to the next slide. This slide emphasizes the importance of the companies interacting with the angel group. So you're looking at percentages of exits on the vertical axis, and again, the size of the exits on the horizontal axis. And companies that have 1 to 2 interactions with the investors per month generally have an average of 3.7x return compared to companies that have only 1 to 2 interactions per year. And that they get, the successful ones give about 1.3x return. So angels know that companies that are interactive tend to give better returns. And so the advice is, as a company, be sure that you're talking to your investors on a regular basis. Next slide. How do you prepare for due diligence? Well, I won't read all of this, but you need to review all the material that the companies have already provided and be prepared to answer questions. Have all corporate filings and so forth ready to go. Be prepared to use a virtual vault of some sort. All your cap tables needs to be organized and easy to understand. Aggregate all your financial statements and balance sheets together and available. All the IP that's been disclosed needs to be there. All the information needs to be in a data vault, which would then support a syndication deal of the deal if necessary. And generally, the ones that are really successful assign one employee with proper authority to be the data coordinator. So that's always a good business procedure. Be prepared for investors to talk directly to employees, and be organized, clear, and provide timely resolutions to all questions. All right, next slide is terms of investment. And so I'm going to just stop here for a second and say that it's now 4 minutes before the hour. Marissa, do we need to stop, or do you want to just keep going for a little while longer?
I think it's up to you, Steve. I maybe finish up the last few slides.
Okay, I will go quickly through another few slides. I'm not going to spend a lot of time talking about terminology here. If there are questions about this stuff, we can get to it later. Typical deal terms, angel and VC equity models. I don't think I want to spend a lot of time talking about that. And this is about investment instruments, convertible debt, SAFEs, KISS, and stock. But I think, again, this is like some details more about stock. Let's go to slide 55. Let's just talk about the post-investment. So once the investment is done, a member of each investment group is usually assigned to follow the company. And, basically, companies exit by either going out of business, or they get acquired, or in some cases they do public offerings or IPOs. Let's go to slide 58. I want to talk about pre-money valuation and investment, and this explains a little bit how this works. So pre-money valuation is what the company is worth before the investment occurs. And so this is an example here let's say that the pre-money value of the company is $1 million. And there's a whole science around determining pre-money valuation. Then you take an investment of $500,000. So now the post-money value of the company is $1.5 million. And the $1.5 million is 100% of the company, but 66% of the company is now owned by the founders, and 33% is owned by the people that put up the investment. So you have to understand that as you raise money, you're giving up shares in the company and control of the company. Okay, there's a whole section in here on valuation, how to determine pre-money valuation. Let me just say that, go to slide 59. The determining pre-money valuation for a company is a fairly sophisticated business. There's some math involved, and there's a lot of opinion. There's three major ways to do that. One is called the venture capital method. It's complicated, and that's used by the venture firms. The other two is called the scorecard method and the risk factor method, the risk factor summation method. Those are the two methods that most angel groups use. Now, I've got slides in here on how those latter two work. I'm not going to spend any time talking about that. At some other time, if it's necessary, we can do that. Let's go to slide 70. I want to very quickly run through what a pitch deck should look like. So slide 70 shows the title slide. And to me, this is one of the most important slides in the deck. It should show your company name. If you've got a logo, that's great. It should have a tagline that's short, about the length of what you're seeing here, a short tagline relaying what the company does. And when you say that and the audience reads it, they know exactly what's coming. So it needs to be very clear from that. There should be no question about what the technology is and what the company's doing. The presenter's name should be here, their title in the company, and their contact information. Go to slide 71. So the next slide is the problem. So explain what the problem is, what's the current standard of care, protocol, whatever. Highlight the inefficiencies and the costs and so forth. Slide 72, what's your solution? What's your technology? How is this going to solve the problem? You can have a couple of data slides here. It's always good to have some slides that show not only what your technology is, but in fact that it works, and some data is good. Be careful about using too much jargon. You got to realize that most of your audiences are not going to be experienced in the field, and so they're going to need to understand what you're doing without having a lot of background. You should also mention, especially for healthcare, what your reimbursement plan is and the healthcare economic features of your solution. And don't include any confidential information. Slide 73, you should be able to talk about the market. So these are standard terms: the total addressable market, the serviceable available market, the serviceable obtainable market, and all of these things are important. I would say that one of the most important things is don't overestimate your serviceable obtainable market. If you say that it's 10% of the serviceable available market, you're probably in the right ballpark. Some people claim 30%, that's usually unreasonable. All right, next slide. Competitive landscape. There's lots of ways to do this. I like the one that's on the left. It says table 4. Basically, I call this the bingo card slide. You have the competitors in the rows, and yours is at the bottom, and you have traits. So trait 1, trait 2, trait 3, et cetera, going across in the columns. And you've got, each competitor has check marks in certain boxes, but the only one that has check marks in all the boxes is your company. And so that basically tells the audience that you know what the competition is, and you know how your technology is better than the competition. Next slide is the barriers to entry. This is the intellectual property. You have to basically in one slide tell the audience that you do have some IP that protects your technology. And ideally you've got composition of matter if you're a drug, or methods, etc. You can also have trade secrets. There can be specific know-how, and you don't have to provide the details. But the other thing is that if you've done a freedom to operate assessment, whether it be informal or not, or formal, you should say that. What's a freedom to operate assessment? This is an assessment done usually by a legal firm or somebody that's experienced in the legal area. And what they do is they look at all the IP out there and they say, yeah, you're going to be able to sell your technology without infringing on somebody else's field of intellectual property. So an FTO is a valuable thing to have, especially if it's cleared, and you should say it if you have it. So, slide 76, there should be a project plan that takes you out to an exit. The only thing I'll just say here is you can talk about how much is it going to cost you to get to the milestones. So you got little dollar signs in there. Do not talk about how much money you're going to raise to achieve these milestones. And the reason for that is that most of your audiences are not 100% accredited investors. And if you give details on fundraising to this audience, you're going to be doing what the F.A.C.C claims is a public solicitation of funds. That's not illegal, but it may make it more difficult for some types of investors to engage with you after you do this. All right, slide 77. The team slide is extremely important. You want the management team, founders, advisors, board of directors. Ideally, you've got them divided into different areas, so the management team is the most important. You have headshots with each of the key people, title, and some brief one, maybe sentence of words on what their experience is. If they have experience with large firms like Pfizer, Medtronic, et cetera, include those logos on this slide. And then, just as much information as you can without cluttering up the slide. It's got to be readable. And then finally, the last slide is what I call the summary slide. And to me, this is also an extremely important slide. What this slide should do is list in bullet form, as you can see here, the major points that you've made in your presentation. And the last bullet is what your ask is. So what are you looking for? Are you looking for investors? Are you looking for strategic partners? Are you looking for a CEO? What are you asking for? And then also on this slide, you should have, again, the company name, your name as a presenter, and your title and position in the company, and then contact information. And so that's slide 79 is the end. And I hope that this has been helpful. I'm happy to take questions if people want to ask and if there's time to do that. Marissa.
Yeah, thank you so much, Steve. I don't see any questions in the Q&A box, but if anybody would like to ask one before we sort of end the seminar today, you can go ahead. Okay. Yeah, Dr. Flaim, I don't think we have any questions today, but thank you so much for dialing in and providing such a wonderful seminar to us and our network. Patrick, do you want to wrap up?
Sure. Thanks, Marissa. Once again, we do apologize for the technical difficulties at the start, but we do want to thank everyone for attending, and thanks to you, Steve, for dialing in via phone to present today. Please do take a moment to complete the survey posted in the chat, and note that the recording and the slides will be posted on the website in the next few days. So thanks again for attending, everyone, and have a good weekend. Bye-bye.